Are you trying to figure out the maximum price to be paid for a business that would match the return on investment for a similar business, but you have no idea where to start? Well, you've come to the right place because I'm Professor Capko, and I'm going to make that super easy for you during this video. But first, I want to mention that I believe something great is going to happen for you today. And now, back to the video. If you believe accounting and finance is hard, give this a thumbs up. Smash that like button so I know that you think that accounting and finance is hard and you could use all the help you can get. Thank you. In this example, we're asking what is the maximum price to be paid for a business to match the ROI, which means return on investment, for similar businesses. In our example, we're going to assume that the typical return on investment, which is ROI, for restaurants in a particular market is 15%. One restaurant for sale generates 19% return on investment because of its location and high traffic. The fair replacement value of its assets is $197,000. What is the maximum someone would be willing to pay for the restaurant if they seek the typical return on investment of 15%? Let's break this down. First, let's understand what is the formula for ROI. I have done some other videos on ROI and acquisitions of targets, and if you want to take a look at those to start with and you haven't seen them, I've got linked up here above. I talk in there about goodwill and the return on investment and how it differs between the target company and the takeover company. Return on investment is there's different ways to calculate it but for purposes of this, it's going to be net income over the assets. And typically we're going to multiply it by 100 simply because we want to express ROI in terms of a percentage. So we can compare different ROIs for different companies, different businesses. And it's helpful to have them in a percentage basis because we think about return on investment. If you think about you're putting your money in the bank, what percentage are you earning on it? If you're borrowing money, what percentage are you paying on it? So we want to convert ROI into a percentage. So that's why we would, once we do this calculation, we would multiply by 100. So we've got the net income over the assets times 100 gives us our ROI. In this case, what do we know? Well, we do know the ROI for this restaurant that is a target restaurant. It is 19%. So we would know that. Do we know the assets? Yes, the fair value or the fair replacement value. In other words, if you just went out and bought the range, the stove, the refrigerator, the tables, the chairs, all of that, if you went out and bought it, it would cost $197,000 if you just bought it and started from scratch. That's our assets. Do we know net income? Nowhere in our example are we told net income. Does that mean everything comes to a halt? Of course not. We're going to figure out what net income is first, and then we're going to use that to figure out how high we're willing to go to pay for this restaurant. Let's go ahead and fill in what we know. Our ROI is 19% for this particular restaurant. I'm going to divide that by the 100 and just go ahead and put it as 0.19. That way we don't have to worry about multiplying by 100 again at the end. So I've gone ahead and divided by the 100 and moved that decimal place over. So the 0.19 is the same as 19%. If you don't remember how to or need some refresher on converting decimals to percentages and back and forth, I've got a video linked up here that will give you a nice refresher. This is going to be equal to our net income over our assets. Our assets, we know because we're told in our problem, the fair value is $197,000. If you're actually purchasing a restaurant, you would do that research maybe do your due diligence, have it appraised, something along those lines, and we know that's 197,000. We don't know what our net income is. So I'm going to call that X. And we're going to solve for X just using algebra. So this is our setup to start with. I want to get the X by itself. So let's multiply both sides by the 197 because that's in the denominator and I want to get it out of there. So I'm going to multiply both sides by 197,000. These cancel out. So I'm left with my X is equal to the 197 times 19%. Let's pull out our calculator to see what that is. So if I start out with 197,000 and I multiply it by 0.19, that gives me 37,430. That is our X, which is up here, which is our net income. So I can write down net income is equal to 37,430. Now this net income is not going to change in our example. Of course, in reality, once the restaurant's taken over, that may go up, it may go down, it may stay exactly the same depending on the new management and many factors that are outside the scope of this video. For purposes of calculating how much we're willing to pay, our assumption is that it's going to stay the same. So that's our net income. We're going to reset up the problem. We use the same formula. The ROI is equal to net income over assets times 100. I'm going to go ahead and assume we divided by 100 and put down the ROI that we're seeking. We're happy with what the market is generating for other restaurants. It would be great to get the 19%, but this restaurant owner is probably well aware that they are making more as a return on an investment than their competitors. And therefore, they're going to ask for a premium. And that premium is going to be in the form of goodwill. And if you don't remember what goodwill is or not sure, I've got a video linked up here where I explain how to account for it. But they know that most investors would be happy with the 15% return on investment. So they're going to ask for more than the replacement value of the restaurant's assets. So as an investor, happy with the 15%, that would give us our maximum because we don't want to pay anything that would make it so high of a payment that we would get less than 15% because why buy this one? We'd buy a different one that we could get 15%. So the maximum we're willing to pay, we're going to figure that out now, but we would go up to 15% return on investment, no lower than 15% on investment, equals, and again, our same formula is net income over assets. Well, we know the net income because I told you that's going to stay the same, 37,430, but we don't know the net assets. That's going to be the total amount we're willing to pay to get this income, that return on investment. So I'm going to make that a Y. I can make it any variable I want. I don't want to confuse it with the X up there, so I just make it Y. We're now going to solve for Y. We're going to do that by doing algebra. So I'm going to multiply both sides by Y. These Y's cancel out. So I'm left with 0.15 Y is equal to 37,430. Again, I want to solve for Y, get Y by itself. So the 0.15 is multiplied by Y, so I do the opposite. I divide both sides by 0.15. And that gives me, that cancels out, Y is equal to, and look at this, I've already got this in the calculator. That was my answer earlier, so I can just leave it there and divide by 0.15, and that gives me 249,533.33, and if I round that, 3333, it's going to just be 33. So the maximum we're willing to pay is $249,533.33. And that will give us our return on investment, assuming that the income stays the same, that is equal to 15%. So now you know how to find the maximum you're willing to pay, but there's so much more you need to know. So go ahead and subscribe to this channel and click that notification bell so you don't miss a single video. Until next time, keep your grade alive and subscribe. Thank you.